The Golden State finds itself in the throes of an unprecedented financial quandary as California grapples with a staggering $68 billion budget deficit. This monumental fiscal shortfall is primarily attributed to a profound downturn in revenue, marking an exceptional challenge for the state's financial stability. The Legislative Analyst's Office, LAO, points to a substantial decline in revenue as the chief culprit behind this budgetary crisis. At the heart of this decline lies a cascade of events, starting with a delayed tax collection in the 2022 to 2023 fiscal year. This delay stemmed from the Internal Revenue Service, IRS, extending tax payment deadlines for individuals and businesses in 55 of the state's 58 counties. This extension, initiated in response to a series of natural calamities ranging from severe winter storms to landslides, ultimately disrupted the state's revenue stream. Compounded by these postponements, California found itself compelled to craft its 2023-24 budget based on projections rather than concrete tax receipts. Consequently, the actual impact of the economic downturn on state revenues remained unclear during budget formulation. Notably, income tax collections witnessed an alarming 25% decline in the mentioned fiscal year, a plunge reminiscent of the financial setbacks experienced during the Great Recession and dot-com bust. Aaron Mellon, Communications Director for California Governor Gavin Newsom, emphasized the predicament. Federal delays in tax collection forced California to pass a budget based on projections instead of actual tax receipts. Now that we have a clearer picture of the state's finances, we must now solve what would have been last year's problem in this year's budget. However, the fiscal turmoil doesn't stem solely from delayed tax collections. California has faced a multifaceted exodus, a departure of both residents and businesses, which directly impacts tax revenues. The state witnessed its population dwindle for the first time in 2021, losing approximately 281,000 residents. Subsequently, in 2022, an additional 211,000 residents bid farewell to the Golden State, seeking new homes primarily in states like Texas, Oregon, Nevada, and Arizona. Escalating housing costs have emerged as a significant driver of this migration, with 34% of Californians considering relocation due to the financial burden of housing expenses. Furthermore, the post-pandemic trend of remote work has spurred a migration away from California, contributing to vacant office spaces in its urban centers. These departures, combined with housing woes, have set the stage for a complex economic landscape. Another pivotal factor in California's financial downturn traces back to the actions of the Federal Reserve. With 11 interest rate hikes between March 2022 and the present, the Federal Reserve aimed to curb inflation, inadvertently impacting California's economy. These hikes, elevating borrowing costs, triggered a domino effect. Home sales plummeted by roughly 50%, attributed primarily to the surge in mortgage rates. The monthly mortgage expenses for a typical California home soared from $3,500 to $5,400 amid the Federal Reserve's rate increments. The repercussions of these actions extended beyond the housing market. Startups and technology firms, integral to California's economic fabric, felt the pinch as investment plummeted. Evidence lies in the stark decline, over 80%, in the number of California companies going public in 2022 and 2023 compared to the preceding year. Consequently, businesses grappled with constrained funds, resulting in a surge in unemployment from 3.8% to 4.8% and leaving nearly 200,000 Californians jobless since the summer of 2022. Addressing this colossal deficit demands immediate action and a nuanced approach. The LAO has outlined several options, including tapping into cash reserves to mitigate the crisis, potentially withdrawing around $24 billion. Furthermore, reevaluating school spending, potentially saving $16.7 billion over 3 years, stands as another measure. However, these solutions, while offering short-term relief, might not comprehensively resolve the state's underlying financial challenges. Historically, California has resorted to measures such as curtailing business tax credits, augmenting broad-based taxes, and seeking avenues to generate additional revenue. Yet, the path to long-term fiscal stability necessitates a holistic strategy encompassing prudent spending cuts, revisiting taxation frameworks, and fostering an environment conducive to economic resurgence. While specific details of the state's recovery plan remain undisclosed, officials assure the public that a balanced budget proposal, slated for introduction in January, will grapple with these challenges. The emphasis will be on safeguarding essential services, bolstering public safety, and ensuring judicious use of taxpayer funds while addressing California's pressing fiscal predicament.